Inside Options is brought to you by the Johannesburg Stock Exchange. Manage your risks with Safex style options.
Hello and welcome to Inside Options. I'm Jane VG. Today's program centres on Safex style options, and joining me as usual to talk us through what these are and how they work is the JSE's James Boardman. Welcome, James.
Hi, Jane.
So what is Safex style option exactly?
Safex style option is a particular type of option. There are lots of different types of options. We're going to go into some of them later. It's generally referred to as a style of option. And Safex, well, you can see I've got a logo up here. Safex is the South African Futures Exchange. It doesn't exist anymore. We've been bought by the JSE, now part of the JSE since 2001. Safex was founded in 1990 by a bunch of guys from RMB who decided that they wanted to have a futures market in South Africa that would enable them to manage their risks a bit better. So they set up the South African Futures Exchange. Quite interesting. Set up in 1990 with trading of futures just on a few things. There are a few products that they listed, mainly big indices and one or two government bonds like the Goldie and the Aussie, and I think it was the E186, one of the Eskom bonds that was quite liquid in those days. Then in 1992 they decided to list options. Because they were a separate exchange, they didn't have a spot market to list these options on. So they copied what other futures markets around the world had done, and they used a pure futures option. This is partly because it's the legacy of when Safex was set up. When we set it up, we decided the best model to look at was probably the CME. That's the Chicago Mercantile Exchange. So at that time, and today as well, the CME is probably the biggest integrated futures and options trading market in the world. And they've got a very particular way of doing things. One of those things is called SPAN. So our whole risk management system is kind of based on the ideas behind SPAN. That stands for Standard Portfolio Analysis of Risk. And it was a very, very interesting way of managing risk on a portfolio basis. So let's just look at these logos here. That's Safex. There's the Johannesburg Stock Exchange logo. And there's sort of the combination of the two. That sort of Safex is gradually being sort of phased out. We decided we should probably revive it for the Safex style option brand. So if you guys have been watching the show, you've probably seen the billboards before and after the show say, manage your risks with Safex style options. That's what tonight's show is about, explaining what a Safex style option is, sort of how it's maybe slightly different.
Right.
So the key difference is between a future and a spot. A futures market, you pay each day a tiny bit. What's important are the changes in value. There's no big upfront capital outlay. You just put down a small deposit and then you take on a big position, but you have to pay in or receive cash each day as the position moves. So you pay up today, the full amount. Jy moet betaal die hele ding. Elke dag 'n little rukkie. That's what happens with a futures market. So that's the difference between these two markets. Now, an option, there's another type of option, which is probably the CBOE type of option, which you've probably read about in textbooks and stuff overseas. And that you pay for the whole thing up front. You pay your whole premium today. So if you decide to buy an option on a share at R3 a share, on 100 shares, 300 Rand, you have to pay the full 300 Rand today. With our style of options, you don't. That gets margined each day like a futures contract. The other really important point is that the underlying is not the spot. The underlying is a futures contract.
Okay, so this is the real point of differentiation here, and this is how the
Exactly.
Americans do it, and this is how... Is this unique to South Africa?
No, it's not at all. It's actually in most markets where there are only sort of futures rather than a liquid spot market. So I know the Aussies do it on their index. They have these pure futures style options. In the States, on quite a few of their indexes, and on maize, gold, oil, a lot of those things, there isn't such an active spot market. So you can't have options on the spot. There's a much more liquid futures market, so you tend to have the options where that liquidity is on the futures.
Now, it all comes down to margins, doesn't it?
Yes, it all comes down to margins.
Okay.
In the traditional model, only a seller of an option is margined. In our model, both the buyer and the seller are margined, based on the risk of their position. So this is how we do our futures margins. You can see this graph. I've pulled it up in a bunch of other episodes. It's a real favorite of ours. What it is how frequently something occurs is on the up and down on the Y scale, and on the X-axis is the size of the move. So these red lines are 3.5 standard deviation. So that's where we set our margin. That's sort of a worst case scenario. You can see very occasionally there's bigger moves do happen. And that's in the rand dollar. That's the blue one is the top 40. So you can see it's actually more volatile than the rand dollar exchange rate. So because of that, we set that at a level where it's safe. Only 1 in 200 days it's going to be a complete train smash of a day for us to be pushing up against those levels of initial margin. We do the same thing with options. However, if you'd watched some of our previous episodes, an option's quite an interesting financial instrument. With a future, your risk is delta 1. It stays at delta 1 the whole time. So for each 1 rand move in the spot, it's going to be a 1 rand move in the futures price. If there's an option with a delta of 0.5 for a 1 rand move in the spot, there's going to be a 50 cents move in your premium. So your risk is actually usually quite a bit smaller with options. So what we've done is we've looked at that, and in our margining process, we look at the delta of your overall position. And then we charge you a margin based on that.
Right.
So I've actually got an example of that, which we can look at. So here are our basic margin things. So this is the fixed margin for an Aussie contract. As of 12th April 2011, you had to pay 18,000 Rand for that contract. The VSR is a volatility scanning range. This is quite technical, but what it is we're stressing the volatility as well, because a future's just got one input that changes the value. That's what is the underlying doing. An option has two. What is the underlying doing, and what is the volatility doing? What is the forecast of how volatile the market will be in the future? So we have to take that into account as well. So the great thing about using this margin offset system is this is a calculator you can get on our website at jsc.co.za/margin calculator, just all one word, and it'll do all your calculations for you and show you what you pay on a portfolio basis. This is pretty amazing. Here, if you just bought the call option, you'd have to pay 16,380 Rand. If you just bought a future, you'd have to pay 19,000 Rand. But because the one is hedging the other, your total margin is 2,260 Rand. So that's a massive reduction. It's 9 times less than if you just did one of these on their own. So we are acknowledging that overall, this portfolio is much less risky. You're balanced with the delta here. Problem is, the delta changes.
Right. We're going to take a break quickly at this point, James. We'll be right back, and I think we'll be looking at apples and oranges,
Exactly.
literally, after the break. Don't go away. We'll be right back.